Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com.
Welcome back, Washington, D.C. Metro, to Real Estate 360 Live. I am your host, Ryan Sloper, joined today by my guest, Louis Cammarosano, the General Manager of HomeGain. Reminder that the show is designed to build the Washington, D.C. Metro's housing markets by giving you good free advice. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030. Or visit us via the web at realestate360live.com. That's realestate360live.com. Live.com. Any questions or concerns that you guys have when you get to the website, just click the Ask a Question button. Leave any questions that you may have in your contact information, and we'll get back to you. So, Louis, home ownership rate hovers near the 65% point. I got this survey, I believe, was from the Census Bureau information, which is in line with Fannie Mae's recent National Housing Survey. They did 1,000 respondents that were interviewed for the survey. 67% of the people showed a preference for buying their next home, while only 28% said that they would rent. Now, I know you guys, HomeGain, does a survey all the time. Are those numbers somewhat consistent as to what you're seeing in your surveys?
Well, the survey that we did recently was the home ownership satisfaction, and we found, as we were talking about earlier on the show, that home ownership is high. The percentage of homeowners that are satisfied is at 72% overall, but those that have bought short sales is at 83%, and foreclosure is 77%. So there is a lot of interest in home ownership. The question is whether people can actually get the loan, they can afford it, and whether they have the jobs to sustain the mortgage payments.
Yeah, the million-dollar question at this point is am I able to buy that home? You know what I mean?
Whether I want to.
Yeah, exactly. Yep, the demand is definitely there, and it's shown in many of the statistics that we had pointed out on previous shows that in some cases as many as 50% of loan applications that are put in are ended up being denied for one reason or another. Now this can be very frustrating for people out there, and I mean it's almost what I've actually seen firsthand in the markets lately. Is that people are becoming – it's almost a norm now for loans to not be ready and close on time, for there to be extra conditions for that loan to close after they were already basically all the original conditions were already cleared. I mean, the actual job of loan officers out there is probably ridiculously hard at this point because they feel like they're going to get all the documentation necessary, and at the end of the day the underwriter is the one that controls whether somebody is going to get the keys to that house or not. And I always urge people, and this is such a big deal, like there's small little things like deposits that are going into your bank accounts to be able to justify them with proof, not just say, hey, I deposited $1,500 cash because my mom gave me that money because she owed me money for something. That's probably not going to be a good enough reason. And see, there's 100 of other issues outside of just like a deposit like that could be a problem that could keep you from getting a loan. Now, you might say
additional consumer debt.
Exactly. And many might say, well, why does that matter? I have an 800 credit score. I make good money. I have good job history. And unfortunately, it's only one little thing that gives them the reason to deny the loan. And it may not be a good reason to you, but the lenders, I mean, they just want the cream of the crop at this point in time. And they're going to scrutinize your loan the same way that they scrutinize somebody with a 660 credit score, a 620 credit score. And, Louis, you and I talk about it all the time. It's like the banks are going to be more picky now than ever because they really don't want to make loans at these interest rates. So
they've already got a huge bad debt portfolio, and even with the Fed helping bail them out, it's still too big.
Right. Every week, I mean, there's a new set of guidelines for, for the way that you calculate income, for the way how many years of employment history you have to have. I mean, it's an ever-changing underwriting guidelines. I mean, or it's almost every day, it seems like. So you need to really make sure that you're working with a professional. I tend to tell people to steer away from internet-based companies where they're using these teaser rates to entice you to call. I don't really think that that's a good foundation of working with a lender that's going to have your best interest at hand there. When most of the times they're have these teaser rates that are thrown out there. When you call, it was like, oh, well, you don't have a 740 score and you're not putting 35% down. It's now more than ever really important that you're working with true professionals that can help you navigate the loan process, because it is definitely it's a different world from where it was 5 years ago. It's not very easy to get a home loan these days, regardless of how qualified you feel you are. I've seen many loans for people that are well qualified that should close and they don't, and a lot of the times it could have been prevented, but you need to be probably speaking with a lender and a professional, probably 3 or 4 or 5 months ahead of you actually buying the house, and not 30 days. Many make the mistake, Louis, of, well, I've already found a few homes by doing my research online. Then they call the real estate agent and say, hey, I really like this house. Can we go take a look at it? And then the real estate agent says, well, are you pre-qualified? A lot of the times when they go through the pre-qualification, it's a simple phone call to the lender. They don't necessarily have all of their W-2s, their tax returns, their bank statements. They're taking, basically their word for it. So they'll issue a pre-approval letter that says, with the intent that I'm going to receive all these financials and it's the same as what they told me, then they'll be approved for the loan. Well, it doesn't seem very smart to go about it that way, if you're asking me.
People, Ryan, don't even start with the pre-qualification. That's probably the first thing you should do before you even look at your first home.
Absolutely. That's the first step. If you're considering buying a home, I would urge people, don't even look at houses online. I know that you'll have the urge to see what's out there, but don't do that. You want to find out what you're going to qualify for and what's going to put you in a comfortable payment range.
And then you know which homes to look at.
Exactly, because what most people do is they go online, they assume what they're going to be qualified, they assume what they want their payment to be, because they use all these online calculators, most of which are inaccurate, by the way, because they're not saying, okay, this is an FHA loan, which is also going to have mortgage insurance, you also need to make sure that you have the proper taxes and homeowners insurance in there, the HOA fees. They don't calculate all those things. So they go online, they find a $350,000 house that they love, and then they go to the lender, and the lender says, well, $350,000 is probably going to be the very top of what you're going to be pre-approved for, and it might be a payment that's uncomfortable. You get emotionally invested into that house at that point, and it's kind of like, you're discouraged because now you have to take a step down, and none of the other homes are like that one.
Or you end up making a mistake and you stretch your budget to get that $350,000 home, and then you miscalculate a few expenses. The next thing you know, you're living off your credit card.
Now, many would ask me, Ryan, well, what if I know that my pay has been increasing year over year over year, and I feel like, I'm going to be getting these bonuses? Can I stretch a little bit? I would say that, in certain instances it is okay for people to stretch, but typically you need to make sure that you have a cushion for yourself. A cushion meaning that, if you're going to make your payment maybe $200 or $300 or $400 higher than what you'd really be comfortable paying, make sure you got $20,000, $30,000 saved up so that there's not going to be any issues if you don't get that pay increase for any reason.
Or you lose your job.
Or you lose your job the next day. You can still afford to float yourself for 6 months to a year with the money that you have saved up. Now, I guess people feel like they're just immune to being laid off from their job or for just tremendous hardships happening, but they do happen, guys. And I've always been a big advocate of people, living within their means and, not overextending themselves. Because when we got into the mess 5 years ago, it was because people were buying above their heads because that's what everybody else was doing. And, I think it's important now, especially if you're going to take advantage of these low interest rates, make sure that it's affordable. Because,
while people are trying, is the natural inclination is to do after you go through a horrific debt implosion, you start to build back your savings. But we're hearing all kinds of signals from the government that we shouldn't do that. That's not patriotic. We should go out and borrow more money and spend more money. So, you're getting conflicting messages, and you're right. That's what people should be doing, and that's how people should approach mortgages. But I'm sure there's a lot of people out there that are looking to buy still as much house as they can afford based on the interest rates.
Yeah, it's awful interesting that the government's always pushing, put that back into the economy or pay the bank, don't pay yourself. I mean, wouldn't it be smart if everybody just started saying, hey, I'm going to treat myself as a debt and pay myself? You know what I mean? Because
it would be nice if you can save money and put it in the bank, but there's no interest there. So you're kind of encouraged to toss it at the stock market or to go out and borrow money and buy a house.
Yeah, but even you and I have discussed there's other things that you could potentially do with your money. I mean, you could buy silver, you could buy gold. I mean, there's some other things that you could do if you wanted to.
And people are doing that, but not in large numbers.
Yeah, not in large numbers.
The percentage of investable assets in gold and silver is under 1%. So people really aren't doing that, even though the prices are skyrocketing of gold and silver.
Yeah, and then I think we'll continue to see that be the case over the next few years for sure.
Well, especially money not just in the U.S. but the European central bank, Japan, China. That's inevitable that commodity prices are going to continue to rise.
Yeah, and
silver.
It's almost a mirage of what's going on right now in the stock market. Obviously, people are like, "Well, look at the stock market rallying." I mean, well, that's great, but the majority of average Joes are not in the stock market. It's your huge institutions, it's the banks, it's the people that have all this money sitting on their balance sheets that they're just now investing in the market because they need to make greater returns. If they're lending out money at 3% interest rates, that's not going to be good enough for them. They're going to want more. So where are they choosing to go? The stock market. We're creating another asset bubble. This is definitely not. It seems like we over and over just continue to do the same things. And why
that's all that the Fed knows how to do. I mean, that's what they do. They print money.
Exactly. But
they create asset bubbles. They inflate.
But what the Fed is clueless in my mind is that the old definition of inflation, or what I believe is the real definition of inflation, is an artificial increase in the money supply.
And credit, correct.
And credit. And what are they doing? That is inflationary. But the way they're manipulating the system and controlling the markets and has Wall Street buying into their every move, it's like for some strange reason everybody's thinking that we're just going to be okay and the Fed's going to save us.
It's a monopolistic dictatorship in the control of money.
We're coming up on a break, guys. When we come back, we will dive into your questions. One from a listener, his credit score is 595 and wants to know if he can buy a home. We'll let you know when we come back.